Chinese stocks rise after more stimulus was promised over the weekend, but bond investors remain wary. Singapore holds policy but turns dovish even as growth strengthens. And India's inflation unexpectedly jumps in September. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, as global currency markets shift in reaction to monetary policy easing, ANZ international economist Kishti explains what that means for Pacific Island currencies.
The Australian dollars and the New Zealand dollars performance against the US dollar largely dictates where the Pacific mid-rates go, whether it strengthens or weakens.
But first, in 5 and 5 with ANZ. US markets were quiet due to the Columbus Day holiday, although the S&P 500 still managed a 0.75% rise. Oil prices were down just under 2% as weak China price data dampened views on growth prospects. Staying in China, export and import growth both slowed in September due to typhoons affecting port activity. But the main focus there yesterday was equity investors reacting somewhat positively to Saturday's stimulus briefing, with the local CSI 300 index rising 1.9%. ANZ senior China strategist Zhao Pangjing says sentiment on stocks might hold, although bond investors were feeling less positive as they waited on the size of a promised debt increase.
At the press briefing, Chinese officials hinted that the amount should be very significantly large. I think market will try to understand how much fiscal stimulus to go. With this in expectation, I think Chinese market will react positively to the stimulus. We continue to see bond yields to go up in the next few weeks before the NPC standing meeting.
The US dollar index was up 0.37% at 4 a.m. Sydney-Melbourne time. The Aussie was down 0.4% at 67.23 US cents, while the Kiwi was down 0.32% at 60.89 US cents. Number 2. On the global rates front, a big question is when the Bank of England might start its easing cycle. ANZ Chief Economist Richard Yetzinger says it's a big week in the UK, with labour market, wages, inflation and spending data all coming out starting tonight.
Inflation has been coming down, but non-tradable or services prices have been sticky, and while activity has been soft, it hasn't been terrifically weak across the economy. So I'll be assessing them against that sort of matrix to see what it signals about the Bank of England. Look, cuts in the UK seem inevitable, as they do elsewhere, as this kind of sporadic easing cycle continues. But as with any mid-cycle slowdown, the exact data prints matter quite a lot for what's delivered from one meeting window to the next, and even the quantum of the move from one meeting window to the next.
Number 3. The Monetary Authority of Singapore held policy yesterday, but shifted to a more dovish outlook. ANZ Head of Asia Research, Koon Goh, expects easing from early 2025 after the MAS changed its policy view from remaining appropriate to now being consistent with medium-term price stability.
They've also dropped the long-standing sentence that they had about closely monitoring global and domestic developments and remaining vigilant towards risk to inflation and growth. So the fact that they had this sentence in the last 4 MPS and they dropped it today, I think clearly indicates that there is a shift in their view. And finally, they're seeing inflation outlook as more balanced compared to 3 months ago.
Number 4. Singapore's Q3 GDP rose 4.1% from a year ago, compared to expectations for 3.8% and up from 2.9% annual growth in Q2. Koon says as long as inflation continues to moderate and fall towards its long-term average, as forecast, the strong growth shouldn't stop the MAS from easing.
This is a sharp acceleration from 2.9% seen in Q2. And this was largely driven by the manufacturing sector, which is finally rebounding and benefiting from the global semiconductor upturn.
Number 5. India's annual inflation in September was 5.5%, almost half a percentage point higher than expectations. ANZ economist Dheeraj Nim says the data hasn't changed his view that the Reserve Bank of India can cut from December, given most of the surprise was due to vegetable prices, which will normalise.
Persistent food inflation, which is inflation in items like cereals and pulses and oilseeds, etc., which tend to have a dominant effect on household inflation expectations, eased to 4%, the lowest since November 2019. So this is quite important from the perspective of future food inflation and its impact on household inflation expectations. At the same time, core inflation was only slightly higher by about 10 basis points at 3.5% in September, so still below 4% and broadly well behaved.
Dheeraj Nim there. Now in our bonus deep dive interview, ANZ international economist Kishti explains what a combination of global monetary policy easing and an RBA on hold for longer than everyone else stance means for Pacific Island currencies.
Look, several Pacific Island countries, including Fiji, Samoa, Tonga, Solomon Islands, and Vanuatu, have adopted a fixed exchange rate regime as a natural hedge against volatility in currency movements. Now, this doesn't mean that currencies don't appreciate or lose value. Exchange rates do go up and down in line with the ebbs and flows of major global currency movements. But by having something close to a fixed exchange rate policy ensures that exchange rate volatility is reduced. So stability in the exchange rate in turn provides a natural anchor for imported inflation. As you know, Pacific has a very small manufacturing base, so a lot of goods are imported into each country, and reduced volatility in the exchange rate means imported inflation does not get out of hand, essentially. But at the same time, it must be said that by going down the route of a fixed exchange rate framework, exchange rates can't play the inflation buster, a role that stronger currencies can do in a free-floating exchange rate environment. So on balance, though, policymakers in the Pacific think the dividends from a low, stable imported inflation are far more desired, and as a result, stability in exchange rates wins as a policy choice. And that's why we see every Pacific Island country is persisting with a fixed exchange rate regime of some sort at the moment. It gives the exporters also some peace of mind when they're converting their foreign currency returns to local currency, and the same goes to importers as well.
So how are those sort of daily rates that we see at the banks? How are they derived, Kishti?
Okay, the rates that are quoted on a daily basis by the commercial banks, the rates that customers see are derived of what is called the mid-rate. Now, it is a rate that is announced by the central bank to the market around 9 a.m. each trading day, and it essentially values the home currency against the US dollar. So the mid-rate is often characterized as the official exchange rate. So you have your Fiji dollar against the US dollar, or the Western Samoan tala against the US dollar, or the Tongan pahanga against the US dollar would be your official exchange rate. Now, the official exchange rate, or the mid-rate itself, is calculated as a weighted average of a basket of currencies. Typically, your key trading partner currencies, and these invariably have some combination of the Aussie dollar, the New Zealand dollar, the euro, the Japanese yen, all against the US dollar. So the Australian dollar and the New Zealand dollar typically have the largest weights in the currency basket. And its heavier weighting means the Australian dollars and the New Zealand dollars performance against the US dollar largely dictates where the Pacific mid-rates go, whether it strengthens or weakens, but at the margins though. Now, our view is that both the Aussie dollar and the Kiwi will make small gains against the US dollar through to the end of 2026 or mid-2026 at least. So the appreciation of the Australian dollar and the New Zealand dollar against the US dollar means the Pacific Island mid-rates will shift higher too, albeit modestly. So we see a slightly stronger mid-rates going forward.
So what does that mean then with those slightly stronger rates? What does that mean for trade for these Pacific economies?
So, Alex, we don't expect a stronger mid-rate, which is essentially the home currency against the US dollar, to hurt Pacific Islands trade that is invoiced in US dollars. As I said, the gains are fairly modest, so I don't expect it to have too much of an impact on the US leisure travelers to the South Pacific. Now, importers will benefit though, although the discount from currency strengthening would be fairly small in the overall scheme of things. You really need the Australian dollar approaching US 80 cents for it to start materially impacting Pacific Islands US dollar trade. But that really depends on a very positive, a good news Chinese economy story. Now, we are not forecasting that, so we are unlikely to get to that scenario.
Kishti Sen there. I'm Alex Tarrant, standing in for Bernard Hickey, who is away on family leave this week. That was 5 and 5 with ANZ for Tuesday, October the 15th. Catch you tomorrow with a preview of New Zealand's Q3 inflation data.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.